Ladies and gentlemen, good day and welcome to Jain Irrigation Systems Limited Q4 and FY23 earnings conference call hosted by KRChoksey Shares and Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ashwini Trivedi from KRChoksey Shares and Securities. Thank you, and over to you, Mr. Trivedi.
Thank you, Neeraj. Good afternoon, everyone, and welcome to Jain Irrigation Systems Limited earnings call to discuss the quarter 4 and FY23 results. Today we have on call Mr. Anil Jain, CEO and Managing Director, and Mr. Vipin Walmie, the Chief Financial Officer. We must remind you that the discussion on today's call may include certain forward-looking statements that may involve known and unknown risks and other factors and must be therefore viewed in conjunction with the risk that the company faces. Future results, performance, or achievement to differ significantly from what is expressed and implied by such forward-looking statements. Please note the results and presentations are available on the exchange and our company's website. I now request Mr. Anil Jain to take us through the company's business outlook and financial highlights, subsequent to which we will open the floor for Q&A. Thank you, and over to you, sir.
Thank you. I would like to welcome everybody for today's Concall. The fourth quarter and for the entire year, company has made a lot of positive progress. If we really focus quickly first onto the overseas transaction, which we completed almost on the last day of the March, we have been able to help significantly reduce the debt to the tune of almost 28 billion rupees because we did this transaction. It has also helped us to improve net worth by approximately 1,500 crores. That was the second major thing it has helped us. It has taken care of the corporate guarantees which were given to the overseas bondholders and other loans to the tune of $300 million, which appeared as contingent liability in our books. So that is now fully relinquished. When we had announced the transaction in June, it was subject to certain antitrust approvals by various government authorities around the world. And it took some time, almost close to 9 months, to get that whole process completed. And during this period, we had to pay a little bit more to bondholders. So that has resulted in less equity. So we had announced in June that we are likely to have closer to about approximately 22% plus minus equity into the merged company. Instead, I think we are closer to 18.7 and odd percentage, and that reflects the additional debt payment and small amount of reduction into the enterprise value than what was announced in June. But that is behind us now. The transaction has been successfully completed, and the new MergeCo, headquartered between Singapore and Israel, will continue to operate and run its business with the professional management, and between Temasek and Jain as two main shareholders into the company. That company is expected to continue to grow, and post that growth, maybe 3 years or so, directional thought process between shareholders is that we should make an attempt at possibly listing of that entity. But it is too early to say when, how, and what. But directionally, that is where that will go. So over the next 2 to 3 years, we are expecting, both as shareholders, that this company will continue to grow. It could also create additional synergies between merger and improve its earnings apart from the revenue growth by using both companies' product lines. The last part of this transaction is that we will continue to supply certain products to this entity from perspective of exports. This company would take our product and distribute that around the world. India business would directly only deal with India as well as the subcontinental countries like Bangladesh, Sri Lanka, and so on, about 4 or 5 countries. And company would also be able to participate directly in any Government of India or Exim Bank related irrigation projects outside India, which are usually backed by letter of credit. So that's with the merger of our overseas irrigation business. It has been very successful, and we are very happy that we could conclude it in right time, and it would allow now management to focus more back onto business in India as well as the other businesses which we have. Another important event in the March quarter, for which we are reviewing on this Concall, was that we completed 1 year of the restructuring. The restructuring of the company with the lenders in India was signed on 25th March 2022, and 25th March 2023 we completed 1 year. And as per the RBI rule, the banks have a choice and ability to upgrade the account post completion of 12 months. And in our case, prerequisite to that is that rating agencies should also treat the company's credit as investment grade. And I'm happy to inform that CRISIL and ICRA both, upgraded the company's rating to investment grade BBB minus by end of March. And the banks thereafter have been able to also certify the account as a standard asset. What that means is that no bank has any provision against all the loans they have lent to the company, and company's accounts are standard. Company is currently servicing all the debt on the due date, and overall we feel comfortable that going forward also we do not expect any issues in our ability to honor all the debt obligations. So there has been, I think, second biggest and most important thing which has happened in this quarter, that company's assets have become standard with the banks as well as with the rating agencies, and company's account has been standard and current. The third important part of this overall what happened is that the business has done very well. Our underlying revenue has grown almost by about 39%. And when I'm speaking this is standalone business in India. High-tech division grew about 27%, and plastic division grew actually about 56% based on good orders on the Jal Jeevan Mission initiative being run by the government. In terms of this is standalone, but if we look at also Concall performance, and so standalone business is high-tech agri division and plastics division. When we talk about Concall, that would be in addition of the food business which we have, as well as the overseas part of the plastic business. So overall, that business has grown this quarter 27% from 1,372 crores to 1,745 crores. And individual businesses, high-tech is mostly India only, so it is about 26%, plastic is 45%, and agro-processing grew at about 7.5% in the quarter. Now, when we look at this, because fourth quarter is the last quarter of the year, you also look at the annual numbers. The revenue growth for standalone India business has been about 28% from 2,800 to 3,600 crores. So almost addition of 800 crores in the overall revenue in India basis, where about 24% growth was in high-tech, which includes micro-irrigation tissue culture, and 36% growth came into plastic, which is pipes, mostly pipes in India. For Concall business, we grew by 21.4% from 4,700 to about 5,700 crores. So let's say we've added about 1,000 crores. Again, high-tech had grown about 24, plastics 28, and agro-processing for the whole year grew about 12% to about 1,665 crores as against last year 1,483. So all in all, good secular growth across all the divisions and all the businesses. And we believe this level of growth which we have achieved while for the Concall year we grew only about 21%, but overall we expect current year, FY24, we would be expecting to do better than the last year, even though last year was also very good across the board in terms of revenue. This revenue growth which we have got has come through a lot of new business in what we call retail. So let's say in high-tech agri division, we sell our products to farmers by our dealers. That's what we call retail. And retail has much lower footprint in terms of working health cycle. Receivables are very nominal when we sell to the dealers because almost we are collecting in advance, maybe few days of credit. So that allows us to improve the cash flow, grow the business, but do not need any additional debt, let us say. So that's what our focus would remain even in FY24. Plastic business, there are two parts. The PVC is again with the similar terms where we almost receive advance from the dealers. But then there is a polyethylene pipe business which will go into the JJM as well as to other people, institutional business, what we call it. And there the receivable cycle can be up to 90 days, but that's also a very important part of our overall business. Now, our effort going forward in FY24, and as you will see from our investor presentation which we have shared on our website, that we are trying to significantly bring down working capital cycle. And for standalone India business, it had come down to about 250 days as against 314. And for Concall business, the net working capital is at about approximately 197 before adjusting the accounts receivable from the merge co, because that is expected to definitely come through in the current year. In April, we actually already received about 135 crores. So again, the idea and thought process is to further improve the working capital as we will move along in the current fiscal year. While for the growth of the business, the absolute amount of inventories may go up a little bit, but receivables, because we will be collecting more receivables from the government when as we complete the project between current FY24 and FY25, those receivables will keep coming down, and that would help us that any additional working capital we need for closer to 30% revenue growth for FY24 can already come from a recovery of the old receivable, and therefore we do not need any additional capital, and we will still, based on the cash flow generation, we are expecting and good growth. We are still expecting that the debt could go down to the tune of closer to about 600 crores approximately. Now, when we look at the debt, what is the current debt of the company? And that's a very important issue for all the stakeholders. So there is a debt in India, so standalone balance sheet, and then there is a debt overseas. So combined net debt now is approximately 3,581 as of March 23. This debt, as I said, we are expecting the debt to go down, and the actual repayment would be there to the tune of about close to 600. So let's say we are expecting FY24 debt would be closer to approximately 3,000 crores. That's where we would intend to go. The current debt which we have, this 3,581 crores we have, there are two parts of that debt. Right? There's a working capital debt to the tune of almost 2,200 crores across all businesses. Now that is a normal interest-bearing debt. Then remainder about is approximately around 1,500 and odd crores of a term debt across different businesses, which is there. Now part of this is interest-bearing, which we have to and it will fall due for repayment over the next few years, and we need to pay that off. And part of that is during the restructuring, part of unsustainable debt was converted into 0% NCDs. Now, these NCDs are due actually to be repaid in FY27 and FY28. But under the restructuring agreed with the banks, as we collect some of the overdue receivables, they need to be used to repay these NCDs. So kind of prepaying those as we collect these receivables. So we are expecting maybe another 300 crores or so of these NCDs would be prepaid in FY24. In terms of the interest outflow, actual cash outflow of the interest is expected around 310, 320 crores. That is interest plus finance charges of running the business. And however, when you look at our FY24 P&L, you might see that figure is higher by about 60 crores. And the reason for that is that this is a non-cash adjustment of the fair value. So because NCDs are at 0% and they are payable over a longer period of time of 27, 28, under the accounting standards, when we account for those NCDs in the books, you put them at a lower value. And then every year, as you go closer to the time period when they are going to be settled, you keep adding that much cost at the interest level into P&L. That's how accounting standards work. So there would be that amount which will come as part of the finance cost, but that's not a real cash outflow. That's merely book entry, which is there. And we will be putting up precise calculation and details of this also on our website, so that there is a full clarity of the investors in terms of what exactly that means on impact it has on actual cash flow, because no particular cash outflow is linked to that higher interest cost. As a company, then if I a little bit move beyond this now, as a company, the main businesses which we are, what we have tried to do over the last couple of years is to rejuvenate our dealer network, strengthen them, work with them more closely, because that's the one where working capital cycle, as I said, is far better, and also company can improve its earnings by selling more. So and that's where a lot of growth has come through last year. So current year also we will remain focused on that. We'll remain focused on opening more dealers in areas where we are not there. Traditionally, we've been more in Western and Southern India, and now we are improving more in North and Northeast. In terms of that's mostly for irrigation. Same thing applies to our PVC pipe business, where we sell pipes to the farmers. Some of the pipes, as I said, which go into drinking water applications and other applications, that's the institutional business, and that we do already across India. Overall order book is at 2,300 crores across all business segments. Earlier when we used to have the government projects, the order book used to be much larger, but we have stopped taking new government. That's why you see the order book size has come down. But a lot of our business comes from the dealers and they do not typically provide orders for the 6 months or year. Those are monthly orders, right? You receive order, you supply, you consume, and so on. So the mere number of 2,300 crore does not directly signify the company's ability to do the business. Business is coming, on a continuous basis in that major part of the business segment going forward. But overall, we feel fairly comfortable to say that about 30% revenue growth we should achieve for the business we are continuing, excluding the business which has been taken on. So I think maybe I can stop there in overall. And for the next year, I think we as a company, while we are looking to bring down debt by 600 crores, our company would have approximately about 175 crore rupees of capex. I think about 75 crore of that is pure capex related to maintenance, and about 100 crores would be the growth capex. The growth capex where we are investing would come mostly for two specific parts of the business. In a piping side, we are investing more into fittings, which would allow us to sell pipes also into urban areas and into building construction, residential buildings, and so on. And the remainder, about 50 crores, would be invested to build additional capacity in our tissue culture business. Our tissue culture business, while it is small today, but we are seeing a lot more demand coming from farmers, and we are also adding a little bit more capacity for additional products. So traditionally in tissue culture, we have done mostly banana, then pomegranate, strawberry, these 3 or 4 crops. But we have over the last few years through R&D, we have added potatoes, we have added sweet orange, papaya, we are doing mango, and there are some more products in pipeline. So we need to make some investment into that business. Banana also, our existing product line, we are planning to double our capacity because we see sustained demand from the farmers in that business. And payback on these investments on tissue culture should be about 2.5 years. In plastic piping, maybe it is closer to 3 years. So those would help us to sustain high double-digit growth going forward. In terms of overall capacity utilization, our main businesses, normal business of drip irrigation or the pipes, I think currently we are at about closer to 60%. And we think between FY24 and FY25, with the kind of growth I'm talking about, we might be able to hit closer to about 85%. That's our thought process as we speak. So companies do not have, do big plans in terms of the new capex. One thing I would like to urge all stakeholders that our company's business sometimes can become very seasonal. It partly depends on monsoon, partly depends on the rain or whatever else, and it is usually backloaded. So large amount of business and earnings come from the second half rather than first half of the year. That is just the nature of the business. So it is very difficult for company to say each quarter we will do so much and so much. Or if you are tracking based on quarter, you cannot just multiply by 4 times to arrive at the annual result. That may then paint a wrong conclusion or a wrong picture overall. So if you look at risks to this plan which I'm talking about, there are always about polymer prices, which is one of our main raw material. And there we see that the environment may remain benign in terms of availability of material. So there's some new production capacities coming up in India. On the polyethylene side, on PVC side, with China slowing down, Europe and USA also slowing down, there could be enough availability. And so by all experts whom we talk to or we see the market trend, it is expected at least between now and December things will remain subdued. Of course, this is barring any unforeseen geopolitical events which we do not know of today. I think that is where we are right now. And I would now like to open the floor for questions from me or all of you may have. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Avinash Mehta from Parami Financial Services. Please go ahead.
Hi, thanks for the opportunity. I hope I'm audible.
Yeah. Please.
Okay. I think we would want you to spend 1 minute more on the kind of supply arrangement we have with the merged Rivulis, with the standalone Jain. What is the size of the new entity, and what kind of business, if you can, even if it is a range, can we expect from the new entity? Once you answer this, I have 2 more questions. Thank you.
Sure. So, the size of the merged co is approximately, I think, about $750 million on day one. And we are anticipating in the first year, approximately they would buy from us maybe about $30 million of that from us. Of course, they will add their margin and sell. So, but we are expecting in terms of exports of $30 million. Now, over a period of time, it would be our intention that they should buy more from us. I think there is understanding between us and them that they would also, like to buy more from India, because as long as India can be cost competitive. But this is a new merged company, right? So there were parts of Jain who are part of that company who were also earlier buying, and that is easier. The new part which has come into the merger, the original Rivulis part, those people need to become comfortable with this new product line, the cost, and usually the different brand, all of those things. So that would take some time to work that out. But I think starting point is at least to look at 30 million in year one.
So you're saying when we're expecting a growth of 30%, so you are basically from this merged entity, we are just taking $30 million into account, correct?
Yeah. So most of the growth we are assuming is actually coming from the business in India.
Okay. And is there a finite arrangement in the terms that, is this a 10-year supply arrangement or something like that?
No, this is a long-term supply agreement. I think 10 years or more, that's not an issue. But these numbers we will look at on a yearly basis.
Okay. My second question is on receivables. Although you have said that you would shed more on the retail channel. So what is that we used to do 4-5 years back and we did not do retail, and which increases our ability to do retail as of now, which will release more cash into your system? If you can spend some time on this.
Sure. So I'll answer that question, but on your earlier question, last year our sales of irrigation items to our subsidiaries was approximately 200 crores. 30 million means about 250 crores. So that would show about 25% of growth in the export number to the subsidiaries. So that is just one clarity. In terms of, let me try and explain the type of businesses which we do. So there are 3 parts to the businesses. And when I talk of irrigation, one, when we sell to our dealers, dealer sells to the farmers and dealer pays us, right? And it is not connected with anything government or subsidy, etc. Now earlier, 3 or 4 years ago, we used to provide to dealers as well under this model up to 90 days, sometimes 120 days range of the credit. Post difficulty and post COVID period, we have changed that business model, and we are asking our dealers to actually, pay upfront or as soon as delivery takes place. So that is improving, the cash flow for the company. This is one part. Now there, the dealers whom we have, we have had dealers for a long time, right? 20, 30, 35 years. But we are opening up new geographies where we are also appointing dealers. So, for example, 4 years ago, we had almost no business in Northeast area. Right now it's about 40 or 50 crores. The other states where we have very limited sales, like UP, we expect this year to have again 40 crore sales in UP and so on. So it is combination of rejuvenating or strengthening existing dealers and also having more dealers into the new area. The second part of the business which we did, what we call government business, there are two parts to it. One is the project where we took EPC projects. Now this EPC project was to get water from a given area, bring it to group of farmers. And I'm talking of 10, 20, 30,000 farmers, 30,000 hectares, that kind of thing. And then also put drip or sprinkler onto their farm. So it was a combination of projects where water supply and then efficient water distribution on the farm. These projects which we took from the government, and at one time I think total projects we had taken were 4,000, 5,000 crore rupees size. They got delayed in implementation. We were not getting paid in time. So many things happened, and we decided that we do not wish to continue to take financial and political risk of these type of projects. And whatever projects we have taken in hand, slowly but surely, we are completing those, closing those, and moving forward. And we expect all the existing pending projects should get completed over next maybe maximum 18 to 24 months, but most of them in next 18 months. And those long receivables used to be there, won't be there now, because as we complete the project, we'll recover everything what is outstanding, and we are not doing that type of business. Other part of the drip irrigation business, which is what we call government, is that in some states we do not have choice but to place orders through the government. That is how the government programs are run related to irrigation. And while government places their order on behalf of the farmer with the company, and that's how the program runs. And there, typically, on an average, one should assume at least 180 days. During last 2-3 years, we had significant delays from states like Andhra Pradesh. Last year, there was delays even from Gujarat. But most of the Andhra recoveries have been done, and now we are almost current, in terms of new business within that time period of less than 180 days is happening. So there also improvement has taken place in that so-called government business, but it would have a longer working capital cycle. So this is what I mean when I talk of the retail, and we think, there are enough states going forward over next few years which will continue to evolve, understand and appreciate usage of drip irrigation. It's not about just water saving, it's about productivity improvement. It does add value to the farmer's income. It can help them reduce the consumption of fertilizer and so on. That's what our focus is.
Okay, one question relating to your receivables. ये जितने receivables हैं as on date, which is the third channel you were talking about, this government tender, is any of these receivables disputed?
No. None of them are disputed. I think I would qualify that statement. We have one state where about 100 crores or that might go into arbitration, but as of now that discussion is still going on. But I would say 96-97% of receivables are good receivables. Whatever receivables we felt where could be dispute, where there are issues, there could be legal issues or whatever, we have already made adequate provisions in the book. So we do not anticipate in normal course any new provision against the receivables. What the net receivables you see on the books are all good receivables which will be fully recovered.
So you're saying at some point of time in future, whether 3 months or 6 months, this should flow into the company? Yeah.
Especially the project related, over next 2 years as we complete the project, they should flow back.
Okay. So one question, when you said 600 crores is what is the ballpark number you are looking forward to repay as far as FY24 is concerned. So it means you also mentioned that there could be a 300 crores of NCD which can get preponed due to some, is this NCD linked to some of the receivables? Is it mapped to some of the receivables कि वो आएंगे तो ये repay होगा?
हाँ, उसके साथ में है, link है.
Okay. So this is 600 plus 300 crores, correct?
No, see, on net basis, so the NCDs is also debt on the books that will go down, and then other debt which is there, which would be maybe another about 310 odd crores, that would also get repaid.
Okay, this 600, when we were talking about 600, this has that NCD 300 component.
Yeah, that includes that 285.
Yeah, so understood. And one last question, if you can talk about the food processing business, your traditional mango pulping concentrate business, dehydration business. So you have spoken about only 100 crores of growth capital and 75 crores of maintenance capital. With the new Jain coming back in the market with bank facilities, what kind of growth we can see in the food processing business? That would be all from my side.
Okay, so just quickly, I want to correct myself. When I talked about 175 crore, that was a standalone. There would be additional about 50 crore rupees into consolidated numbers. So because there is maintenance capex in the food as well, which is there. So overall, it should be about 225 in terms of capex. Second question, what was the actual questions on the food business in terms of growth?
So with with new resources around the entire company, what is the kind of growth we can look forward to in the next 3 years in the food processing business?
So, food business, if you break the food business, it's about 650 crores out of India, export and domestic sales, and about 1,000 crores with the overseas subsidiaries in the food business. So that's about 1,650 crores we did this year. We think, because during last 2-3 years, again, with the kind of difficulties we're facing, our capacity utilization was low. We did not have adequate working capital. We are seeing a good order flow from some of our, B2B customers on the juice beverage side, or even, as an ingredient on the onion or garlic side. So we are confident of maintaining a growth rate for the overall business about 20% plus. The India could be growing higher than 20, but global basis, it will be growing also 20% plus.
So you are saying that this capacity was underutilized. So because of working capital, you were not able to process as of players like Coca-Cola, etc.
Last 2-3 years, that's correct.
Okay. Thanks a lot and all the very best.
Thank you.
Thank you. Next question is from the line of Suraj Navandar from Sampada Investments. Please go ahead.
Hello, sir. Good afternoon.
Good afternoon.
Sir, what would be the sustainable EBITDA margins for the business?
So, again, there are different divisions. Traditionally, drip irrigation, which is what is partly high-tech, our margins are around about 17%. The piping, which is comparatively low margin business, but also requires less amount of capital, we have been able to hit closer to double digit, about 8 to 10% over last few years. Idea as we improve the capacity utilization going forward with better fixed cost absorption, and also as we use more capacity, we are buying, larger quantity of raw material where we could make some volume. Our idea would be that about piping or plastic business we could take to 12% going forward, combined basis. So when you will combine these different, and food is at about 12.5-13%. So when you combine all of the businesses put together, in a good year, you might be between 14 and 15. In a bad year, you might still be around 12%. So currently, our internal target are we closer to 14%. And as we are coming out through difficult time, where we are, gaining back market share on substantial basis, but at the same time also improving the cash flow. So we are trying all the three things, right? So I think revenue growth is back, margins are more sustainable now, and cash flow is also happening. So all these three is what we are looking to combine.
So the operating leverage is going to be the major driver for the margin expansion going ahead.
Yes.
Okay. And sir, do you expect any further improvement in your working capital cycle?
So there are working capital cycle will definitely improve, as I explained. As these government projects close and some of those old legacy receivables we get fully paid only after the closure of the the project. That would bring down the overall receivable levels, and that should definitely improve working capital cycle. Also, as company, as I said that we are now BBB minus, etc., could mean that we could get better supplier credit, which would also help shorten the working capital cycle, or our net contribution into working capital would be less. In terms of inventory, while inventory might slightly go up in absolute amount, but let's say inventory goes up 10%, but revenue is growing 30%. So in terms of days outstanding against sales, working capital cycle would shrink. So overall, I think at least this year, March 24 and March 25, in both years, I believe you will see a visible reduction and improvement into overall working capital cycle.
Okay. And sir, considering the elections that we have in this year, around 4 to 5 state elections we have, so do you expect any halt in tendering process or any changes over there?
As I said, we are not actually doing a lot of new government business, right? We are not, going for government tenders and so on. So there is no direct impact. But it is true that whenever elections are there in that given state or area, usually, 6 weeks before there are this, guidelines or whatever, and that slows down the bureaucratic process or any process of, farmers getting funds in their hand, or whatever may happen in marketplace. But, we have enough business now across India, so if some states things slow down, you can push your product somewhere else. That is one. And I think general elections are next year, sometime May. So overall, I'm talking still as of now what we are planning to do current fiscal of FY24. We don't anticipate, anything significant in terms of headwinds.
Okay. And just the last question, can you throw some more bit light on the food processing business? I'm new to the company, so if you can just explain your business model in the food processing business.
So food processing business, we buy large amount of, for example, we buy large amount of mangoes. We make pulp out of those mangoes, and we supply to customers like Coca-Cola and other large global beverage companies in India and outside, where they will make the juice out of it and sell. Other product lines are like onions or garlic, for that matter, which we'll buy from farmers again, process those, create dry onion or garlic, which can go as an ingredient into, for example, Nestle is our customer. It can go into their product in ketchup or Maggi or in export markets as well. So that's the business model. Typically, that has usually less receivables. It has more inventory, because based on the season of the individual crop, like in mango season now as we speak, we have started processing mangoes. So in the next 60 days, we should process all the mangoes and then sell the mango pulp over a 12-month period. So it is an elongated inventory holding cycle against the order. So we already get before the season kind of orders from our customers that, okay, over next 1 year, please supply me such amount of X quantity. And then, monthly basis, there is an offtake. So that's how the business works. While primarily we are in mango and onion, but, slowly but surely we are adding other products more. We are now in banana, guava, papaya, tomato, pomegranate, garlic, so many other product lines which have started working and delivering revenue. But as of, I think, for FY24, majority of revenue would still come from mango and onion.
So when we do these contracts, do we also getting contract with them over the rates, or is it only the quantities that is it we get in contract with?
So we get indicative contracts, right, in terms of quantity, because you process the quantity as per the need of the customer. So customers are, duty bound to evacuate the entire quantity. In most of the customers, these contracts are made kind of middle of the season, by when you already know the raw material price, so you don't take risk on it. With some customers, large customers, we have raw material plus contract. So whatever is the raw material price, it could go up or down, it is passed on to the customers. So by and large, I would say, 80% or more quantities we sell, 80 or even 90, I would say, we do not take any raw material commodity price volatility risk. Maybe it is 5 to 10% product which gets sold on spot, where you might have some risk. But by and large, nature of the business, as it has evolved, earlier we used to, and sometimes it really hit us badly. But I think over the last few years, it is more and more, the entire industry is moving towards this kind of model, because nobody can take that kind of a significant commodity volatility risk.
Okay. Thank you, sir. Thank you very much, and all the best.
Thank you.
Thank you. Next question is from the line of Pawan Yadav, individual investor. Please go ahead.
Hello.
Go ahead.
Yes.
Yeah, hi. So I will have 2 or 3 questions. Very quick question. Question number 1 is that you have, while your revenue grew by just around 20% at the standalone basis, your other expenses have gone up significantly, almost doubled. So can you explain what this other expenses essentially entails, wherein, those expenses have come by impacting the bottom line?
I think, first of all, revenue at standalone was about 28%, so from 2,800 to 3,600. Concall is 21%, from 4,700 to 5,700. Most of the expenses which we have are actually linked to underlying business performance. So there is no significant change. The other expenses could also, I think other expenses would include some provisioning which have been done based on, what you call, we have this ECL model. And if I really look at quickly at the other expenses numbers, April to March for standalone business, 21-22 it was 646, now it is 776. So earlier it was 22.5%, now it is 20.5%. So actually percentage-wise, you would see.
I was looking at the Q1Q number, the December quarter and then the March quarter number.
Okay. So I don't have comparison purely, that would change. But if I have the 4th quarter numbers, if you look at other expenses again, 216 crore was the same period last year, and now 308 crores. But if you look at percentage to revenue, earlier period was 24.3 and now it is 21.9. So actually they have gone down.
Fair, sir. So one more point, that at the console level, if you remove all the exceptional items, including the revenue or the losses or anything, where exactly are we at the operating level in terms of profitability? If we remove all this gain from the Rivulus stake sale and all, if we adjust at the console level, where were we in terms of, say, PBT?
So at console level, when in terms of numbers, right? So if I remove all this one time, because this year this big transaction happened, right? So there are lots of this one-time issues related to accounting standards. So we have some corporate guarantees and that. So we have cancelled those. So there was some gain related to that and so on.
Right.
So based on the operating performance, right, and when we look at console level EBITDA for 23, our EBITDA is about 730 crores. The actual finance cost for the last year was about 340. This is I'm talking cash outflow. You will see additionally 70 crores, which was say 70 plus 40, which was amortization of these NCDs. But actual cash outflow was only 342 from 732. So that leaves, and depreciation was about 236.
Right. Just one last question.
Profit that way is about 150.
Understood. Yeah. Okay, thank you. Just one last question, sir. Most of the question is answered by you about Jain Farm Fresh. Now, initially you were planning for a IPO for the Farm Fresh. Are there any plans? That's part A of the question. And part B, that during the last 2 or 3 years of a struggle, there could be some of your institutional clients who may not have been working with you or maybe cutting down on the business with you. Are there any improvement on that side that you now have compared to the higher number of institutional buyers and maybe the higher sort of quantum of the business that you're doing with them? And plus, are there any plans for the IPO as we move ahead, or any kind of a sort of stake sale in Jain Farm Fresh to anybody to cut down on the debt the way that you did with the international business?
So I think, overall, we as a company and management are clear that as we move forward, as business grows, comes back to the growth, that it should not be debt-fueled growth, right? That we are very clear. And actual debt, wherever it is today, should keep coming down. That's another, we have clear charter for us from our board. In terms of another value monetization event, let's say for the food business, as you asked, as you know, we have also an overseas, private equity investor into food. Maybe down the lane, we need to go for IPO because that could possibly provide them the exit. But the timing related to IPO is partly linked to the market situation, partly also linked to the underlying performance, whether it is robust enough to attract good level of valuation, etc. And I think at least in the current year we are not there. I think food had lost 100 crore rupees 2 years ago. It is back to profit now. So I think this year, current year, it's profitable. So we have covered that deficit, and now it is, I think, in a much stronger trajectory going forward. So as the business improves and if market conditions and are there, and the board of the company then decides, including along with the input from our investor, private equity investor in that company, then I think we will go for IPO. And if we do, then of course it could further help us to reduce not only consolidate by reducing the debt in food, but it might allow us to also give an opportunity for offer for sale and reduce the debt at the parent. So that possibility exists. Question is, but I cannot be certain, and I do not want to unnecessarily create some kind of speculation around the timings of that or the size of that. In terms of underlying business, it is true that we could not process enough quantities for last few years, and at that time some of our customers reduced the quantity they were giving orders to us. But we have a long relationship with most of these customers, almost more than 20 years now. All the global food companies, one way or the other, we have a relationship, and they understand that this was a temporary difficult period we went through, apart from the COVID, our own issues, and that company has come back strong. The parent company is doing very well now. So we are seeing actually signs where some of our customers are now this year for FY24 are giving us the orders which were same as before 19, which we used to enjoy with them. So we are back there now. But again, one has to wait for 1 year to really start seeing, to use cliche, fruits of all this work which we have done.
Perfect. Thank you very much and wish you all the best, sir.
Thank you. Thank you.
Thank you. Next question is from the line of Sanjay Kohli from Goldstone Capital. Please go ahead.
Yeah. Good afternoon, Mr. Jain. Congratulations on achieving all these fantastic improvements on most parameters. Many thumbs up to you. So
Thank you.
I have and great going, and we hope that you consolidating. Just a couple of questions. One on your PVC, on the plastics business. Now, resin prices have been very benign, and you have mentioned that you have some visibility in them being benign. So can we expect that going forward, along with a lot of emphasis on the top line in this business, so pretty decent revenue expectations, that the margins will be maintained at this double digits, at this 10-11%?
Answer is unequivocally yes. And we hope that with better capacity utilization as business grows, we might be able to even improve. But I think our medium-term goal this year, next year, is be closer to 12% on the plastic business. And as I said, traditionally in the past we have been 8 to 10. And there was a period, right, we earned 10 or 10.5 or 11, but it was not on sustained basis. Now where we are, we think on sustained basis, we should have double-digit margins going forward.
Fantastic. And we've been talking to dealers here in the north, and you had mentioned UP as an additional geography to your business. You see, the feedback from the market is that your product line is completely blowout. It's just fantastic. But in the past, you haven't been deploying working capital towards the dealer network on the retail side, which is a great business, as you explained. So, can we expect, because in the commentary it said that your business grew from south and western states significantly. Are we going to be emphasizing on the north as well? You mentioned northeast to add to this dealer network, and what would be the mix between projects and retail going forward?
So, as of right now, the pending orders we have on the projects of the drip irrigation business and piping business put together, I think it's about 900,000 crore is still left to be done, and that will get executed over next 2 years. The retail business is one which is growing. Overall, let's say FY24, almost 3,000 crore rupees of business will be retail business for us. Now, coming back to question on western and southern states, those have been, traditionally states with, little bit less water, right, availability. And therefore, it has been easier to push through the sale of the concept that with less water you can do better agriculture. In north, it was difficult, but we are definitely seeing, we are doing very good business in Haryana, for example, in north. We have very solid plants in the current year in Rajasthan. UP, for the first time for us, as a state, would cross 50 crores. So, we have states, right, who are like Maharashtra this year alone, as a single state, we will be crossing 4 figures, right, more than 1,000 crores, 1,400 crores, somewhere in that region for pipe and drip put together, just retail sales. We have states like Andhra or Karnataka or Tamil Nadu, where like 200 crore rupees in that state with drip and pipe together. In northern states, there are a lot of states we are like 0 to 50, not less than 50. Most of them 10 crore, 15 crores, like that. So comparatively less. But UP this year would be the first time we would be crossing 50 crores. So our idea is that each of states which is in 0 to 50 should move towards that 50 to 200 criteria, and what is in 200 should move to 2 to 500, and so on. So we are deploying, within the organization a lot more resources to develop the dealer base in north, northeast, and east, areas where we have comparatively weak presentation. Our product line, and I do not want to boast, but if our products are available, most of the farmers would just like to buy Jain because there is nobody else who has that level of breadth and depth and the quality and consistency in terms of product. But at the same time, we, with the new business model, we do not wish to give open credit to dealers, etc., because then you are again subjecting to yourself to the same kind of situation we got in 2-3 years ago. We don't want to do it. But we are getting now good dealers who are willing to invest, right, or willing to carry inventory, or who are willing to pay upfront and take the product. As they see more and more the, profitability they can make. Most of the agri-input products like fertilizers or pesticides, the distributors hardly make 3-4% margin. In drip irrigation, they have ability to make 10-12% margin. So it is also attractive for them, but as long as they're willing to invest. So, some of these efforts is going to be a 2 to 3 year effort where you will see significant changes in terms of different zones in which we sell. But that push for north is definitely out there.
Okay, great. Mr. Jain, just 2 short questions which have short answers. One is on the overhead portion. The last 2 years, you've gone through a major restructuring, and so it would have cost you a lot of money to hire all these foreign consultants, lawyers, etc. Over the 2-year period, I'm assuming about an amount of about close to 100 crores per year. This is not going to be there going forward. And very quickly, I'll put the second question also. The overseas food business has done really well. How much of the revenue is attributable to the raging price inflation going on in Europe, which seems to be very sticky, and how much to volume growth?
Okay.
And I'm done here. Thank you. Thank you very much, sir, and बहुत Mubarak ho.
Thank you. Thank you. Those exceptional expenses will not be there. They were treated as exceptional expenses related to restructuring, and they were indeed, right, you are correct. They were about 200 to 150 crores, including for the bondholders globally, etc., the amount of dollars we had to spend between the lawyers and the courts and all of that. And those will not be there going forward from the current year. In terms of second question, food inflation is there, but actually, we had used downtime, right, to cut down our costs, change the product mix around the world in each of the divisions. We're very focused on seeing that this should never happen again, what happened. So there is a significant improvement in underlying operating performance, apart from the inflation which is there. And, that's where you're seeing good results. So currently, based on all the inputs we have from the overseas subsidiaries and the CEOs there, they are expecting also another strong year in FY24. Thank you.
Thank you. Next question is from the line of Rajendra Shah from Fidelity Investments. And a request, please restrict to 2 questions.
So with all the runway for growth and consolidation improvements, so any projection as to when you'll be back on the dividend list?
I think it's too early to say. It's partly also linked to the, what the lenders talk about, right? When they did the restructuring, they usually put some caveat, right? Company cannot issue dividend without our consent. But the good part is that lenders now, we, as a part of restructuring, we issued them equity. So they own 10% of the equity, right? So they might become more amenable, going forward. Because they themselves will get it as they are also important shareholders into the company. But,
yes.
I think if I am talking now as a management, keeping the issue of the lenders aside, I think at least for the FY24, the focus in whatever internal accruals we do is on reducing the debt. And that way, I think significantly add to the shareholder value rather than focus on the dividend right now.
Yes. Thank you. Thank you.
Thank you.
Thank you very much. And I'll hand the conference over to the management for closing comments.
No, I think those were good questions from everybody involved. As I said, we are very keen to keep growing, but not at the cost of debt. We will grow, but we would be continuing to remain very focused on working capital cycle and reduce that cycle, bring down the debt, bring up the margins in the plastic business, as I said, with better capacity utilization and better buying opportunity, and stay focused in terms of where we're going. And we would like to thank all the shareholders, all other stakeholders who have supported the company in very difficult times over the last 3-4 years. That was threat to existence of the company. But I think we have come out well, and we would like to thank everybody for helping this happen. And, I think we are strong and positive about the opportunity ahead, and where we never have to repeat or go through the same thing what we went through earlier. Thank you.
Thank you very much. On behalf of AlphaStreet Shares and Securities Private Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.
Thank you.